Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode we are going to look at using investors in a property deal. So what are we looking at here? We're looking at how we would potentially use their funds, which is really popular in property, how we would use their funds and integrate that into a deal to make it viable from a lending perspective. Okay, so who is this for? This is for any property investor really that's looking to move into their next project and is considering working with somebody who could possibly be an armchair investor, somebody who has some spare cash to invest in a deal for a better return, or somebody who wants to be more active in property going forward and so on. So if you are an investor that's considering, a property investor that's considering working with someone else and using their capital, then this is very much the episode for you. So let's dive straight into it. So yeah, using investors in a property deal. There's probably three main ways in which you would look to do that. Okay, and we'll cover off all three. There's pros and cons to all of it, and we'll also cover off how that works in terms of lending. Okay, what does that mean by way of both bridging and mortgages? So the first one we've got then is a loan to you personally. So you've got Mr. or Mrs. Jones who have got 100,000 in capital. They like what you do. They've seen you on social media. They've got in touch and they're going, well, look, we've got a bit of money that we want to invest. We've seen you're in property and you've asked about money. Can you use our funds? So in that instance, they're not just going to give you the money. Obviously, you're going to agree with them that you're going to borrow the money in some way, shape or form, and you're probably going to pay a return. Well, you are going to pay a return. They're not going to do it for free, no doubt. So what are we looking at? So you can borrow that money personally. So I, as the property investor, could speak to Mr. and Mrs. Jones and say, right, well, I will borrow the money off you personally. Okay, so we'll have a loan agreement that lends it to me. I will pay you the interest rate. Okay. Now, the question here will be security. So what security am I giving to the lender in this instance? Okay. And that depends really. It depends what you've got available to give. So what you couldn't do, unless this was 100% funding the deal, you couldn't offer the property as security, because if you're going to go to get a bridging loan or a mortgage or something of that nature, then they're going to want first charge. Okay. Could you offer them second charge? Possibly, but you'd need the consent of the first charge holder to grant the second charge. And usually you're going to be getting their money first before you then go and get the bridging, or you might bring them all both together. But again, it's a consideration. If they're lending you the money personally, then you are personally liable for that as well. Okay, so that's something to bear in mind. It's quite a clean transaction. If you don't pay, they come after you. Okay, depending on the assets that you own, then it'll be determined as to what you need to sell, or if you've got the cash and so on and so forth. So it'll be a personal liability, but just be careful of offering the actual target property as security. The reason being is it'll just stop you getting borrowing. So only do that if they are the sole funder to this project. You would then personally, if you are going to do the project in a limited company, you would then do a director's loan to the limited company. So you would now that I have the money, would lend that to my limited company so that I can use the funds to do what it needs to do. Okay, so that's the mechanism that you would use to use investor funds. The second option is that you can have the investor, Mr. or Mrs. Jones, they can lend the money direct to the limited company. Okay, so it cuts you out of the chain effectively from a personal perspective. And they would lend it direct to the company. So the loan agreement would be between the limited entity and them. Okay, same rules apply really as to you'd be paying them an interest rate, no doubt. Security is still a question mark, okay, in this particular instance. So you still can't give them the first charge because especially if you're going to be using other lenders, they're going to want first charge over it, okay? And you're going to need to give them, no doubt, a personal guarantee. So what is a personal guarantee? Now, as an owner of a limited company, you're limited in liability, limited company, hence the terminology. So what most lenders will do is take something called a personal guarantee. That ties you as the shareholder director to the company, which means that if the company can't pay, you personally will pay. Okay. Now, in some instances, some lenders or investors will be happy with that. It depends on their attitude to risk. Also depends probably on what you're paying them in interest. If you're paying them 20% a year, then it's unlikely they can demand that they have all this security as well. If you're paying them 4% per annum, then that's a very low cost loan, which probably commands a higher level of security. So it's all relative to the level of risk that you're going to take. But just remember that you can't give them the actual target property as a first charge because you're going to need that if you're borrowing from elsewhere. You could do something called a restriction, which means that they register their interest at land registry. We've covered off previous securities in a previous podcast. So if that sparked a bit of interest, then please do listen to the previous episodes. You'll find it on our website. But yeah, again, they just lend that direct to the company. When all is said and done, the company will repay it back to them. Okay. So those two are taking the money in by way of loan. Okay. Now, when it comes to bridging, that's really not so much of a problem. Bridgers are far more relaxed as to where the funds are, how the deposit monies are made up. They will still expect you as the project owner and so on to have a contribution towards it. So in many instances, you can't do 100% of investor proceeds just by way of loan and then you have the rest. They want to see you having skin in the game, as they call it. Okay, but certainly using bridging, loan to you personally, loan to the company, both usually acceptable. Okay. Now, if you're going to go straight to a mortgage, far more difficult. Mortgage lenders, by nature, are more risk averse. Therefore, they want to see that the capital is yours to leave in the project long term. So, how would you overcome that? So, the other alternative could be that you would look to do a joint venture with the investor. Okay, so that could look a little like this, which is you would set up your company, ABC Limited. I would be the shareholder because it's my project at 50%, say, and then Mr. and Mrs. Jones would also be 50% shareholder. They would inject the money into the business themselves, so that they would be loaning it through a director's loan account. That money then sits in the limited company, and that can be used then however it sees fit. The security for Mr. and Mrs. Jones is going to be that they own the shares of the company, so whatever assets that owns, they will be 50% shareholders to that, okay, or 49, 48, whatever you agree, but you get the point. And then that is quite a clean way of doing it. That will allow you to go straight to mortgage. And because obviously directors' loan accounts are perfectly acceptable as a deposit source for mortgage purposes. Invariably, obviously, they're going to share in profits, again, a share of capital and all that sort of stuff. So it is a different structure. It's not a loan. This is actually a joint venture. So you are technically, well, you are going into business with them. Okay. So on that note, it's a very different level of due diligence that you're going to be undertaking. The shareholding, as I say, also I've seen this happen before where the people coming in with the money, okay, with the cash, just because they've got cash doesn't mean their credit file is particularly good as well. So make sure, and I've seen people get caught out where the joint venture partner who has the capital has got blips on their credit rating, which means it's very difficult for them to get mortgages. And that's caused all sorts of issues in the future. So make sure you do your due diligence as you would before you get into business with anyone. Okay, so just make sure you have a look at that. And then the other thing to remember is source of funds. So irrespective of whether you do a loan, joint venture, or what have you, source of funds is going to be asked. Okay, this is whether it's bridging or mortgages. So what I would always recommend is if you are taking money from a third party, you need to do your due diligence on where that money has come from. Okay, so have yourself an audit trail, ask them for bank statements, where has it been, and make sure you document that you've done the relevant works. If you want to be squeaky clean with it, get it done by a solicitor. So the money gets paid into a solicitor then via you. They will have to do their detailed source of funds checks. Okay, I appreciate there is a cost associated to that, so it's probably relevant or relative to the sum of money that's being borrowed. But certainly do your due diligence as to where that's come from, because even if you don't need it at bridging stage, where you come to pay off that money at a later date, the mortgage lender will ask you for the source of funds from the investor in the first instance. So I would suggest you do that at the very beginning, because it's very, the investor's going to understand why you're asking those questions at the very outset. It's pretty obvious why you're asking those questions. Collect the necessary documents, whether that be bank statements and so on. If the money is going through multiple bank accounts, you want the bank statements off multiple bank accounts. So track it as far back as it goes until you can see the build-up of the money. Keep that in a file, because you will need to share that with a lender at some stage in your journey. Okay. Also, it's good practice from your perspective. You do not want to get caught up in something that you are unaware of, because ignorance is not an excuse, unfortunately. So make sure that you are fully aware as to where the funds are coming from if you're borrowing from a third party. So yeah, that's pretty much the three main ways that you can use investors' money in property. The main takeaways from this are: please do not give a first charge to the investor if you intend on using another lender. The other lender will need it. Please do your due diligence on where that money is coming from. You do not want to be caught up in something that you didn't intend on getting caught up in from a legal perspective. Also, making sure that if you are working with investors, that you set their expectations in regard to timescales. It's super easy to say that a project's going to take 12 months. You really do need to understand that if it doesn't take 12 months and it rolls on for 2, maybe 3 years, what are the consequences to them as investors? If that's their life savings and they plan on going around the world in 18 months' time with that life savings, then there is a hard stop on when that money can come back. So just understanding the consequence of having investor money is key as well, because life just gets in the way, right? So you just want to make sure that you can give the money back, or the consequence to the investor is not life-changing in some instances. So that's investors in property and how you can potentially structure those. I'm sure there's loads of other ways. Those are the main ones that we come across. This is specifically in relation to lending, okay, and mortgages and bridging. And if you've got any questions, then just get in touch with us and let us know. Thank you very much for listening. Hope it was worthwhile, and I'll catch you on the next episode. Cheers, guys. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.